So, how do you structure your business to pay less tax? So, quickly revisiting the presentation that we did last week on how business owners get money out of their business and pay less tax, we looked at two different entity types where you can run your business out of, which include a company and a trust. And both had its pros and cons and yielded different post tax outcomes. So, with a company and trust, they have certain different benefits from a tax perspective. So with companies, they have a lower tax rate. And with small businesses, they only have a tax rate of 25%. So you can minimize your tax that way. Companies can also distribute income into future years. So it allows you flexibility over the timing of when you actually have to pay tax. And then also trusts have the ability to distribute income to different beneficiaries. So we can kind of spread the tax burden across different people. So if you want more information on that example, feel free to watch the video from last week. But yeah, just know that there are different entities at your disposal. So the age-old question, do I use a company or do I use a trust? And the answer is, working on Lost Us. Why can't we use both? We know that we both have its pros and cons, and definitely if we can access the advantages, why not take advantage of both? So in a very simple business structure, normally we would have the company, which is 100% owned by the business owner. But in this example, instead of having the company owned directly by the business owner, it can be held by a trust that you as a business owner control. So you are likely the beneficiary and the director of the trustee company. So what happens is that you run your business through this company. You will generate profits, you pay tax at that lower tax rate. And when you are ready, you distribute dividends upwards, which may include franking credits, to this trust. And then from this trust, you can distribute to the various beneficiaries. And that is how you get the advantages or the positives from both the company and a trust from a tax perspective. Pretty cool. So lastly, just some other considerations when asset structuring. Consider the costs and compliance that's involved. So obviously you have to pay for accounting services, tax compliance services, but hopefully those costs are offset by the potential benefits that you have. So always do this cost benefit assessment to determine whether or not it's the right strategy for you. The next thing is complexity. And I know that the diagram below is quite small, but some people just like operating under one entity, and just know that it could potentially grow as well. So that we've seen different businesses where even more complex structure may exist, and that might work for them for their tax strategy specifically. But just know that there are different levels of complexity that your entity can be structured. And then lastly, asset protection. We'll need to consider where we house assets in which entities. If we're engaging with different suppliers and vendors, are certain entities from a legal point of view, from an engagement point of view, how do we address them? What's the actual engaging party as well? And that's it. Yeah. If you're interested in any tax structuring strategy sessions on what is a potential good strategy for you, and if you need help setting up any trusts or companies, feel free to reach out to the FTC team. Yeah. Anything else, Andrew?
That's the only thing I want to add is just when it comes to the actual trust, the beneficiaries are determined by the appointer at that point in time. And when the profits get distributed to the trust, the trustee has the option to distribute those profits or that income to each of the beneficiaries as they see fit each year. So it can change every year. So you can distribute all the profits to a single beneficiary 1 year, the year after to 10 beneficiaries, etc. As long as the trust deeds are all up to date, meaning the beneficiaries are listed within the trust deed as being able to be a beneficiary of that trust.
Yeah, perfect. And hopefully that's not too much legal jargon for everyone, but that's why it's important to engage in the right advisors who can kind of walk you through the process. And again, it can get a bit complex, and this is why strategy becomes so important, because we might want to time certain distributions to yield the best outcome. That concludes today's video. Feel free to reach out if you have any questions. See ya.